Thank you for tuning in. What you're looking at is the TexasVestments.com website About Us page, an investment club here in Dallas, Texas, detailing who we are and what we do. I'm the club president, Lee Ennis. In this video, we'll detail what we're currently invested in, why we've invested, and what our outlook is for the market. Hope you enjoy and learn something. All right, happy November. Today we're going to go over the previous month of October and see what's going on, see where the market is, find out what we're buying, what we're selling. So this is our portfolio. This is as of November 3rd, actually. Our Thomson Reuters fell quite a bit. Their European business didn't do so well this past quarter, and so the stock price got knocked down fairly significantly. But it was really a bit of an overreaction. Not going to add any shares quite yet, but we'll keep a lookout for it. Bell Canada, again, telecommunications, that thing is ready to sell. Xcel Energy, again, we'll look at some possible replacements. ExxonMobil is coming back. I think the current price is really close to where we got it at. We did purchase more shares on last month. Coca-Cola is doing fairly well. Pfizer is starting to look up. GE has fell significantly over the past month, and that's a good thing for us. We are really looking forward to purchasing more. As you can see here, the amount of shares that we need for a balanced portfolio is actually 42 shares, and we currently only hold 5. So looking forward to getting more shares at GE. Annaly, the mortgage REIT that we picked up last month, has fell about $1. Again, nothing that we're really concerned about. Dividend is still strong, so we'll look for this to come back. Not going to add any shares quite yet. We'll wait to see what happens over the next couple months, especially with interest rates. All right, Weyerhaeuser doing really well. It's getting really close for us to have a sales signal for Weyerhaeuser. We got in at 32. I think right now the price is somewhere in the neighborhood of 36. They just passed a bill, or they're close to passing a bill, to restrict Canadian lumber into the U.S. And so that's a good thing for Weyerhaeuser. They do own some Canadian timber, but the majority of their timberlands are actually in the States. So that will hopefully raise the price of timber and increase their book value. Toronto Dominion has been doing fairly well. We picked that one up last month as well. Seagate already has a sales signal on it. We are not going to sell that quite yet, but it does have a sales signal on it. We will look at some companies in the tech sector to see if maybe we want to replace it. And then these are our orphan stocks. As you can see here, just 1 share a piece. We kind of just hang on to those. They were basically free stocks for us, and we collect dividends on them. All right, let's take a look now at the previous month, and we're gonna look at our table here. All right, and blow this up. All right, that's better. Okay, so we're gonna do this sector by sector. This is the basic material sector. As you can see here, NRP is our MVP. And just to remind everyone, MVP is how many times this stock was included in the best performing portfolio for the month. And this is a 12 trailing month thing here. So this is over the past 12 months, and this has been in the best performing portfolio 6 times. SWM, CMP, AGU, we're here in Weyerhaeuser. Also, I like to keep a lookout for the average return for the month, and we see here that CF is actually the largest return for the month. So I'll do a little homework on CF just to kind of see how they're doing and what's going on there. NUE, very familiar with. Potash, very familiar with. They're in the same neighborhood here. Weyerhaeuser is a little less than 1%, but it's been doing well for us. We like it, and we want to see what's going to happen with this new bill that's coming out here. All right, so let's take a look at the sector. So not bad. Almost 1%. It was 3% in September. This is October, actually. Okay, this is August, and that's of course July. So it looks like the sector has been kind of up and down. Got hit really hard earlier in the year, and now it's starting to come back. So that's good to see. All right, let's take a quick look at the consumer cyclicals. All right, International Paper is the MVP in the group. Thomson Reuters is in second place. Thomson Reuters is where we are. L Brands is right there. McDonald's is where we were. Taking a look here at the monthly averages, we see that Best Buy and McDonald's have really been the sector leaders as far as average return. McDonald's stock has gotten just too expensive for us. We don't like to hold any companies anything more than $120. So that's the reason why we had to get out of McDonald's. It just got a little too expensive. I think the price now is up to like 160 or something like that. So again, let's take a quick look at the sector and see here. Who's at 10%? Someone's at 10, someone's at 9. Let's take a look at those. Looks like L Brands and 17. VFC. All right, don't know a whole lot about VFC. I'll take a look at that one, do a little homework there, and see what's going on and what pushed that price up so high. It looks like it tends to run pretty hot. 6% there, almost 9% there. So this thing has been moving for some reason or another. Like to take a look at what's doing really bad too, because that means a lot. GPC, again, looks like it's just been way up and way down. Who knows what's going on there? It may be one of those companies that people trade in and out of quite a bit, as witnessed here. I mean, way down, kind of up, way up, and then a big sell-off. So that may just be a bunch of trading going on. People going in to get profit and get out. All right, so for the sector, consumer cyclicals, looks like they're about flat. Haven't done a whole lot together as a group. And kind of looking back past couple months, it's really been up and down. But for the most part, it's fairly flat. So I think we did a good thing with McDonald's, had a really nice run. Best Buy is always been a hot stock. It's something that I've been looking at for quite some time. It's hard to get into just because of the competition. You know, they have Amazon and Walmart and a lot of other stores that are selling electronics. They do have a really cool experience right now with virtual reality. I was actually in their store for that reason a couple months ago, I think now. And so, you know, there is something to say about the store experience. But we'll just, you know, we'll keep an eye out and kind of see what's happening with them. And maybe we can get in. I think the dividend is fairly small for those guys too. Let's take a quick look here. Let's see. Consumer cyclical. Yeah, see, it's the score is a negative 100. The reason why is because either the dividend is too small or because the price is too high. And we see a dividend here of 2.4%. That's really small compared to some of the other companies that we invest in, and we like to have that dividend. It makes a big difference as far as returns and, of course, income, which is what we're after. All right, let's go now to the consumer defensive or the consumer durables. Philip Morris, number one MVP, says a lot. Philip Morris has always been one of the best in the sector. Altria is actually part of Philip Morris, or they were. Philip Morris is the American cigarette company, and Altria is basically the rest of the world. So both of those stocks doing really well in portfolios anyway. Walmart looks like they are the best average return, and we are currently in Coca-Cola, and we have been stuck there for quite some time. Hopefully, we'll be able to get out and get some real growth on that consumer defensive side. Let's take a quick look here at the sector overall. Again, looks pretty flat. It's been up and down all year. Hasn't really done a whole lot, and I think that speaks to really kind of what the market is looking for right now, which is growth, not these defensive companies, the durables. Not a lot of growth, just kind of make a lot of cash and hand it out in dividends. The market isn't really looking for that right now. Let's take a look at energy. All right, CQP and ExxonMobil, PSX, ETP. Looks like the MVPs are really spread out in energy, and I think that's because energy itself has not been a hot sector for the past year, for the past 12 months anyway. The oil has kind of just gotten to the level it's at and stayed there. I think right now it's in the $40 to $50 range and really hasn't moved around much at all. Last year, oil got as low as $20 before coming all the way back to 40 and 50. So I can understand why it would be so spread out here. Looking at the average monthly return, looks like Valero is the highest. And I think that's because out of all of these energy companies, Valero, which deals primarily with the refined product of gasoline, is where the market sees the money at right now. Not so much in drilling and discovering oil, but simply selling the gasoline. And ExxonMobil is a really great company, and we like it simply because they do everything. They discover the oil, they drill the oil, they refine the oil, they sell the gasoline. They're doing a little bit of everything. They just recently made a deal with Mexico to take over some of their gas stations, because Mexico for a long time the gas stations were government owned. And so they're privatizing those gas stations, and ExxonMobil is in a deal to acquire a few of them. So a lot of times, the companies are doing the right things. They're making the money, but because of the way they are perceived by the market, they're treated unfairly. And that's kind of what we like, because what happens is eventually the truth will come to light. The market will see that, and we'll see that big pop in the stock. And I'll bet my last dollar. That's exactly why ExxonMobil hasn't done as well as some of these other companies. So let's take a quick look here at the sector overall. And yeah, so it was down last month, flat again, fairly flat sector. Didn't do very well early in the year. Caught a break, looks like December, January. I bet you that's when oil jumped up to 50, and it's kind of just stayed where it's at. But ExxonMobil was cool. They're paying us back those profits and dividends, and we like that. The price hasn't moved around a whole lot, so it's really stable. And I think we'll stay there until we see some profits. But I will follow up on a story, not on a story, but just get the story really right now with. I just lost it. Here we go. With this SU, I don't know a whole lot about the company, but it looks like they're in good company there with the average return, and just kind of looking over the past 12 months, they've been fairly solid. They had this one really bad month there, but every other month, I mean, they've been solid. So I'm going to take a look at them and just kind of see what's going on there. All right, finance. All right, Toronto Dominion is where we are. That is our MVP. Taking a look at the average returns. Finance has been doing really good this past 12 months. All this interest rate talk and regulation talk and taxes and stuff like that has really sent the banks flying. And we've done fairly well. We were in Sun Life Financial, had a really good run there, and now we're in Toronto Dominion. So far, so good. We've actually already gotten a dividend from them, which is nice. And yeah, so just a little bit for the month of October, not a whole lot. Looks like the rest of the sector has done fairly well for itself, especially these guys. Let's see who this is. MetLife. Okay, so insurance. All right, and let's take a look here at the sector. Flat. So that's exactly what Toronto Dominion has done. But looking at all the numbers, you can't really tell that, right? But when you see those two, it makes sense. Let's take a look and make sure that everything's being accounted for. So 68. Yeah, it's all been accounted for. It's all there. Yep, T and AF. Yep. So, so financials flat for the past month, but they've been doing really well past 12 months for sure. All right, let's take a look at health. Looks like Merck is our MVP. It's a pharmaceutical, as well as Pfizer. OMI has the best score in the health sector right now, but the stock just performs horribly. That can be a good thing, so I'm going to do some homework on OMI to find out exactly what's causing this horrible performance for these guys, because maybe they're being punished and they shouldn't be, for lack of a better word. They unjustly, punished unjustly. Which means that, again, that at some point truth will come to light and the market will realize it, and the stock may get a big pop. So gonna do some homework there. We're in Pfizer right now. As far as averages, it's like Baxter is doing a better job. J&J, Eli Lilly. These three companies, even though they do pharmaceuticals, they're more on the consumer side. They sell consumer items, not necessarily drugs. And so I'm sure that is the big difference. Pfizer is almost, completely pharmaceutical. They do have like Advil and stuff like that, but for the most part, it's all about those prescription drugs. And over the past 12 months, at least, there's been a lot of talk about drug prices and things of that nature. And And Pfizer has really weathered that storm well. So we like what they have going. They're really big in immunology right now. They have some breakthroughs coming down the pipeline. So we're happy there, you know. And then there's talk about them breaking up. I've talked about that in other videos, about them breaking up and breaking off like their consumer section and things of that nature. There's also a story that they are getting ready to sell off their consumer line. So that means that, you know, Advil and those types of drugs will be going away, and the company will focus primarily on just those prescription drugs. So what that means is that if the market doesn't like prescription drug companies now, they're going to really hate Pfizer later, right? At the same time, you know, Pfizer will get a big infusion of cash to add to their books. So it'll be interesting to see how the market takes the news. I can assume that they're going to be hit pretty hard, and you know, I will not be upset by that at all. You know, Pfizer, the price is not falling enough for us to add more, so I would love to see that price fall a bit more so that we can actually purchase more shares to get to even. And just to go back in case I don't again, 36 is what we need. 3 is what we have. I mean, 3 is nothing. You know, we definitely need more shares there. All right, take a look at the sector overall. And it looks like it was down this past month, but that's typical over the past 12 months. I mean, look at this. As a sector, they have been just beat up, and let me get rid of this one. Yeah, they've really been beat up. They've had some good months and some okay months, but they've been beat up quite a bit. So we'll hold out and hold on and see what happens there. All right, industrials. GE is the MVP. Paychex is a close second. I love Paychex as a company. Really want to get into it, but we've been stuck in GE. And as you can see, the performance for GE has been horrible. A lot of that has to do with just the market for some reason or another not liking the previous CEO. So they got rid of the CEO. They got a new CEO. He has a meeting that he will be broadcasting in the middle of November. So I look forward to hearing all about that and reading and seeing what he has to say. They have said that they are currently seeking to sell $20 billion worth of assets. Haven't said what those assets will be. Their previous quarter was a decent quarter. Their power unit struggled quite a bit and lost, well, they didn't lose money, but they made less money than they did the previous quarter in the previous year. So market definitely didn't like that. There's a lot of talk about them cutting the dividend. The company hasn't said anything like that. However, they haven't said that they definitely will not cut the dividend. So, you know, it could be a political answer and everything's okay, or they may cut it. If they do, that should drive the price down a bit more, which, again, I don't mind because we like buying cheap stocks, especially a stock like GE that's an American icon. It's been around forever. They are the only conglomerate that we own currently, and they have a lot of great businesses. You know, they have aviation. They are supplying medical machines, MRI machines, things of that nature. I love going to the doctor and seeing the big MRI machine with the GE logo on it. They're doing what else? They have power. Oh, they got into oil and drilling machines, and that's one of the things that people don't like is that they got into the oil business. But they are supplying the industrial machines that the world needs to run. I mean, that is their business. Period. They got rid of their water business, which was pumping water and finding water, whatever. Machines. They got rid of that. They got rid of the lighting business, which was the GE, bulbs and stuff like that. They got rid of their GE appliance line of business. So they've really slimmed down quite a bit, and they're focused primarily on literally industrial engines and industrial machines. They have the locomotive line of business. They just recently got some great deals over in India and places like that. The power business, like I said, it was the one that really dragged down their profit this past quarter. But their power business is mega. I mean, my goodness, they're supplying almost every utility in the country. As far as the machines and generators and stuff like that they use to distribute and collect energy. So again, GE's doing really well, but performing horribly because the market does not like them. So let's hold out and see what the new CEO does, and in the meantime, we'll continue to collect our dividends. Looks like the best performer is Deere. There's been a lot of talk about them. Caterpillar too, which has really been mind-boggling for me, because Caterpillar has performed great, but on paper, the company looks horrible. Let's take a look at the total sector here. Flat this past month. Looks like it's really been flat for the past year. Again, it's had its great times and its bad times, but overall, I have an average down here of 0.11%. So as a group, they just haven't gone anywhere. And to be honest with you, that's kind of what I expect out of an industrial sector. It's just big machines, not a lot of profit, slim margins, but necessary, right? All right, real estate. Annaly is the MVP of the group, followed very closely by DLR, Digital something Realty. Forget the total name, but they rent and lease and sell real estate for data warehouses, for server rooms and things of that nature. They've been doing really well. But Annaly is the MVP. They have been pretty hot. Looks like the best performer is HST, which is surprising for me, because HST deals with hotels, and in my mind, Airbnb is gonna just eat their lunch. But a lot of conference rooms and things of that nature is really what I think drives profit for these guys too, and that's not going anywhere. All right, so let's take a look here at total sector. Again, flat. Looks pretty rocky, fairly flat. Yeah, fairly flat. Hasn't done a whole lot, and a lot of that has to do with the interest rate. When the interest rate rises, these guys have a tough time, because they use debt to finance their real estate, right? And at the same time, when interest rate rise, borrowing gets a bit harder, and so selling their real estate becomes a bit more difficult, because the credit dries up a bit. So we'll have to see what happens. The great thing about Annaly is that when those interest rates do rise, the mortgages that they buy and sell, they increase in value, or they can increase in value, I should say. The ones that they currently hold decrease in value, but the new mortgages that they purchase will be additive to their book. So it's good and bad, right? But overall, though, I think it's the best place to be right now in a rising interest rate environment in real estate, and the dividend is massive. All right, let's take a look here at our technology sector. Looks like Intel is the VIP here. Microsoft, Hewlett Packard, Texas Instruments, and don't know a whole lot about MXIM, but they are definitely sector leaders as far as average return. We're in Seagate right now. Looks like their return has been fairly flat. And a lot of reason for that is because these guys have a high short interest, which I really like. And what that simply means is that there's a lot of people betting on their downfall. So what happens is when anything good happens, those same people that are betting on their downfall have no choice but to purchase the stock, which drives the price much higher. The other thing that I really like about this company is that even though that is the case, their volatility remains fairly low compared to the rest of the tech sector. And let's just take a quick look at that. All right. So let's see. All right. So here's Seagate. Uh-oh. I don't have volatility on this table. All right, well, yeah, it's not on this table. But I can mention here, and let me see if I can find this. We're looking for up in standard deviation. See if I can find it real quick. Up, standard deviation. I can't tell what's being highlighted. Obviously it found it. Alright, it's up and down moves. So upper standard deviation must be this one. Alright, there we go. So based on the portfolio that we're following here, let's take a look. Go down to technology. Here we go. Yeah, Seagate scores the best out of the group. And the reason for that is because, again, like I said, the up move, which is 61% of the time, and that is based on a 3-year average. Okay, what that means is when there's a lot of buying and selling in this company, the price tends to move up, and a lot of that has to do with the short interest. Okay, but this thing is also scored for, like I said, volatility. So it's both, right? It's up moves, but it's also volatility. And that means a lot because typically when you have a short interest like that, you would think that the stock will be very volatile and the price will move down a whole lot and it'll move up a whole lot. And in Seagate's case, it actually moves up a whole lot and not down as much. So that's a good thing. And you can see that evidence here in the down moves, right? It's kind of hard to see the full thing here. Let me see if I can do this. There we go. All right. So looking at the tech sector itself, and we have here Seagate at 38%. If you look at the rest of the sector, 38% is really about the middle, right? The high end is 50, 53, right? The low end is this 11 down here. Everything else is about 20 something. And so again, you have oh no, 30, 38. Yeah, you have this this great up move balanced with the fact that when there's a lot of buying and selling, the price doesn't go down a whole lot. A lot of these you see are about even, except for that one. This one actually moves down more than it goes up. This one is about even. This one is almost half. 60 versus 30, 40. It's about half. So that's a big difference. The other one is this one, and I'm kind of curious to see what this is. I may have to. Hewlett Packard. Wow. Yeah, I wouldn't guess that. And the Hewlett Packard again is one of those companies that everyone is betting to fail, including myself, to be honest with you. I haven't really kept up with the company, so I don't really know what they're doing. But I mean, Hewlett Packard is a dinosaur, right? I mean, they haven't been on anyone's minds for quite some time. All right, let's take a look at the sector here. Wow, big jump, and same as last month, and looks like they've been slowly declining this past couple months. So it's very possible that this is a resurgence. I mean, they have come back with a vengeance, right? So it could be a resurgence. We'll have to keep an eye out and see what's going on. We've had some big moves here too this past month. Looks like Qualcomm. That may have something to do with the settlement that they've been dealing with. I believe with Apple and someone else. Let's see. Intel. Intel's processors are ubiquitous. I mean, they're not going anywhere for a long time. And then 1265, that's Microsoft. Yeah, Microsoft has really come a long way. Again, ubiquitous, not going anywhere for a long time. Where their growth is, I don't know. It's not a company that I follow very closely. I do hear things here and there. The CEO of Microsoft was actually interviewed by the CEO of Annaly this past month. And I read a bit of that interview. And that guy over there at Microsoft has been doing some great things. All right, let's take a look at telcos, telecommunications. Looks like Ma Bell, AT&T, is our MVP in the sector, followed by Verizon. And that's typical. AT&T has been a stalwart of the telecommunications sector, and looking just at the returns here, looks like Rogers Communications up in Canada has been the best performer, and that's a lot of reason why we're in Canada. We're in Bell. Bell is the Canadian cousin of AT&T. They actually split, I think, sometime in the 90s or something like that. So Bell Canada is AT&T in Canada. So, but they're separate companies, right? All right. So let's take a look here at our sector. Looks like they took a bit of a hit, and it's really been a downtrend for the past couple months. And it's been pretty flat. Yeah, it's been pretty flat the rest of the time. I think that this sector is really changing a lot. Instead of being just your ordinary phone companies, I mean, these guys have turned into basically the avenue in which you go about getting your media. It's all about video and things of that nature. Bell Canada, I think, is doing a really great job transitioning into that Media Avenue. They actually have a deal with a company for children's programming. Not the not the absolute best place to be, but it's at least a start. AT&T and Verizon have deals with other media companies, but as far as I know, they don't actually own any content, right? So you just use their devices to view content, whereas Bell Canada actually owns some content, or at least they have equity in some content. Um, and the other thing that I like about Canada is that they don't have the same competition that we have here in the States. There's definitely some competition between Bell Canada and Rogers and Telus, um, but not as bad as what we have here in the States with AT&T, Verizon, T-Mobile, Sprint is in that mix. They're just giving away stuff sometimes. Bell Canada just recently added more cell phone subscribers, which is great, because that's what it's all about, pulling as many customers away from the competition as you possibly can. They are doing better at getting profit from those wireline customers, the customers that still have wire phone lines, the businesses that have wire phone lines. So they're doing great things. AT&T now has DirecTV. I've been watching my TV and movies online since like 2007, 2008. So as far as I'm concerned, cable, satellite, all that stuff is going to go away. All smart TVs are computers that can access the internet and access movies and TV shows. So, you will have companies that are constantly paying for that content to then try to sell that content to their viewers. But it's becoming increasingly difficult to do that, especially when you have so many people downloading and pirating and all this kind of stuff for this content. So we like where we are with Bell Canada. We do have a sales signal on it. So as always, I'll go through and take a look at what our other options are. Again, T-Mobile, I mean not T-Mobile, AT&T is the MVP. Looks like Rogers is best performer. So we'll look at those and just see if we have anything better than Bell Canada. All right, next is our utility sector. I love utilities because their contracts are structured in such a way that they know exactly how much money they're going to make. They know exactly how much money they're going to spend. The only differences are when there is bad weather and they have to maybe do some repairs and things of that nature. But otherwise, you know exactly what you're going to get from these guys, and we really love the utility companies that pay their profits out in dividends. So all these companies are consistent dividend paying companies. Those are the only companies that we even bother looking at, okay? The largest and the most dividends paid. So let's take a quick look. Honestly, I don't know a lot about some of these companies. Southern, I know a bit about. Edison, I know a bit about. American Electric Power, I know a bit about. Xcel Energy is where we are now. Duke, I know quite a bit about. But some of these other ones, Plains All America, I know a bit about them. But some of these other ones I don't know a whole lot about, especially this EXC. The return leader here looks like everyone is about the same. Let's see here, 188, 161. It's all here in this group, and really you can include that one as well. So Xcel Energy, right there in the middle. That's good to see. Let's take a quick look here at the sector. Looks like they've jumped up quite a bit. A lot of this stuff is going to be seasonality. Is that the right word? It's there's seasonality in a lot of these returns. So as far as I'm concerned, it doesn't mean a whole lot, honestly. Um, some seasons are great for utilities, some seasons aren't so great. Um, but they're looking up right now, and that's a good thing, and we'll take that. See, for the past month, looks like these guys did horrible. See who that is. Everyone else is about the same, a few percentage difference. And it looks like we had a big jump up here. So we'll take a look at that one and that one. So PCG and ETR. ETR fell quite a bit. PCG jumped up quite a bit. So if I have time, I'll take a look at ETR and find out what happened there. Why that price fell so much. And we have a sale on XL Energy too, so I'm gonna have to take a look to see exactly what, if anything, we should switch to. All right. So see here. Want to take a look. I like to look at the trailing 12-month portfolios. Just see which portfolios have performed the best. And let's just go down the list here. The dividend portfolio still doing horrible. 167. That one's at 16. I think that's going to be our largest. Let's see, negative 13. They're 0. They're negative. They're 6. Got a 5 there. 3, 3, 3. 6, 8, 9, 3. So it looks like, and it makes a lot of sense, that the two best performing portfolios we have here is down moves and standard deviation, up moves and standard deviation, and then just the pure up moves over here. So what I'm going to do is I'm going to take a look at the up moves portfolio and find out what is in it. And just to go back and explain, this number you see here is actually this is the return from November 2017 from November 2016. Okay, so this is assuming that you purchased this portfolio in November 2016. At that point, it was worth 1873, and now November 17, it is worth 2264 for a total return of 20%. Okay, now what has happened here is that this number is the return minus, let me make sure I get this right, minus the AE, there you go, minus the standard deviation, which is a measure of volatility. I need to make sure though. See, AI, that average minus that plus that. Okay, so it's a bit more complicated than that. So it's the average monthly return minus the standard deviation minus the total return. Okay, and the reason for that being is that I wanted to make sure that I just didn't purely subtract the return from the volatility. I wanted to make sure that the average monthly return was included in the formula, simply because if there's a lot of volatility in a portfolio, but the return was really high, right? Or I should say, if the average return was really high, then the portfolio wouldn't be dinged as much for having that large volatility. You know what I mean? So if the average return was like 5%, right? And volatility is 10%, well, that's not as bad as having an average monthly return of 1% and standard volatility of 6%. You know what I mean? So that's what this number is here, and that's why we use it. I also like to look at the monthly average, just to see what has returned the best, because sometimes things can be figured out using that as well. So let's just see what's the best returning portfolio, and it looks like as of right now that one is it, at the 0.8% a month. And again, that's the past 12 months. 0.21, 0.17, 0.27, 0.04. Yeah, it looks like 0.8%. Yeah, 0.8% is actually the best average return. So let's take a look at that portfolio, and let's just see what's in it. And that was the up moves. See if we can find that really quickly here. That's our dividend portfolio. It's beta, return, alpha, up moves. Here we go. All right. MetLife, Seagate, EMR, SEP, HST for real estate, International Paper for consumer cyclical, SWM for basic, Philip Morris for defensive, Merck for healthcare, CTL for telco, AEP for utility. So, I mean, that says a whole lot. I think that says a whole lot. Definitely something to consider, especially being that we have to look for another utility. We have the option of going into another telco. So I'm going to take a hard look at CTL and AEP when it comes to determining whether or not we should get out of our current stocks there. All right. The other one was the up and standard deviation, and then the down standard deviation. And again, I want to remind you that up and standard deviation is how we are currently scoring all of the stocks in our basket. Okay. And what that simply means is when we look at what stocks are best, we are considering them based on the up and standard deviation score. So as of right now, it is currently the third best performing portfolio over the past 12 months, and we recalculate that once a year in June, and we change which portfolio we're using to grade the rest of the stocks. So right now, that portfolio consists of GE, Toronto Dominion, SEP, International Paper, Philip Morris, Annalise, Seagate, Merck, SWM, and again, American Electrical Power, and SJR for the telco. I looked a bit at SJR last month. I wasn't really happy with it. CTL, I know a little bit about. I'll give that one a second look, though, just because. But this is my second time seeing American Electric Power, so we might have to make that switch. I'll look really hard into it. All right, and then the next one was the down and standard deviation. So looks like it's right next door. Telco has Verizon. Not really happy about that, honestly, but it's worth a look, right? Weyerhaeuser, we're in there. General Electric, we're there. Cisco, that's interesting. International Paper again, Annaly again, Philip Morris, CQP, IVZ. I don't know a whole lot about. That's a new one for us. EXC, and then Merck. So, all right. So we're getting some new names here. EXC. All right. Let's take a look here at our heat map. And on this thing, what I like to do is I like to look for shades of green, and want to try to stay away from the shades of red. And let's just see, based on color, what portfolio performed the best. And so far, there's not a lot of green. There's not a lot of green. There are some bright shades of yellow, though. So that one doesn't look too bad. That's down to standard deviation. What do you know? All right. Let's keep looking here. And I like this because everyone's eye is different. Everyone's going to see things a little bit differently. Because, see, this one looks like it'll be very volatile. Dividend and standard deviation. It did horribly this past month, and then great, and then horrible again. And then this one looks very calming. What is this? Dividend and return. And I bet you, see, right now the average on this thing is a negative 0.49%. If I were to take that first month out of the equation, all of a sudden I have a positive average. But still, though, it's doesn't look awesome, right? But the past couple months, though, it's pretty good. Let's see here. Uh-oh, I think I skipped. There we go. This one doesn't look very bad. It didn't do well this last month, but it's pretty even, And that standard deviation, which again is a measure of volatility, is how much the stock moves up and down. And it, for grading everything by volatility, of course, the return is not going to be great. It's not going to be bad either, right? This one I think is the best one. And of course, it's up moves. And its average is 1%. If I took that 9% out, all of a sudden it shoots to almost 2%. And then the betas don't look very bad either. So, what has the market done? So, this is the total market, and we're looking at points here. So this is October, right? And typically what happens is whatever sector performs the worst, the next month it tends to perform the best. And so what we're looking at here is in October, we had looks like the consumer cyclicals performed the worst, and they didn't quite beat out the rest of the market in November. The next worst performing sector was utilities, and again it didn't quite beat out the sector. What I am seeing though here is that the companies that tended to, except for the industrials, they were up last month and just did horrible. Wait a minute, I got that's health. Huh. Okay, no, health. Yeah, health was up and did horribly, but everything else, these guys, tech kept climbing. I mean, it's off the charts. You got industrials. There you go. Basic materials. They're pretty much flat. They haven't really gone anywhere. So the question is what sector do we bet on outperforming the market, I should say, for the month of November? Um, Typically, I would look for the health sector to outperform, and that's good news to my ear since Pfizer has done so well over this past month. Maybe we see a big move. There hasn't been a lot of talk about prescription drug prices over the past couple months. Everything has seemed to move to tax. That's what everyone's talking about. That's what everyone is focused on. So, if Pfizer sells this consumer unit, maybe the market will react positively. We'll see what happens. Um, I think there can be something. There's something to be said about the sectors that seem to have moved up and kept going up, such as technology. Like I said before, there may be a resurgence in those guys. And if you follow this gray line back over the course of the year, has technology ever outperformed the market? No. I mean, they got real close back in July. Um, but yeah, for the most part, and right here, if I went back a little further, I'm sure I can find some other. But for the most part, though, technology has not outperformed the market. And all of a sudden, this past month, they have done astronomically well. Does that continue? My gut instinct tells me no, it does not continue. Um, but we'll see. We'll see what happens. Again, I like where we are anyway with Seagate, and if that price comes down far enough, we'll definitely add more for sure. Who else? Consumer cyclicals barely eked out a gain in November. Maybe they continue up. Um, Finance pretty flat. Depends on what happens with this tax and financial regulation and interest rates in December. So we got some time to wait for that. And let's see. And this is kind of just a bar chart. I like to stare at this thing. It's kind of difficult to see, but you can kind of look at the different portfolios and see um, how they've performed over the past months. And the other thing I really like about this chart is that it shows you month by month how the overall market has done. So you see here in October, most of the portfolios were actually up, right? Here in November, we see that there's only a few that were actually up. So you come here, that's negative, that's negative, that's negative, right? Here's positive, okay? There's positive over here, performed really well, almost 3%. I think that's probably the best performing portfolio. Let's see. And see what I like about that is, see, that is the beta portfolio, okay? Now, beta stocks, okay, are the stocks that perform the best when the market is not doing so well. Okay, when the market is down, these stocks perform the best, and that's the reason why I like to have a bit of beta in whatever stock I choose. Okay, same thing with up moves. When there's a lot of volume, these stocks tend to move up. Right, they're second best performing portfolio. Third is beta and return. See, so it has the beta in there, but also they have these are stocks that return the most on average. And then September, we see everything was way down except for up and standard deviation. See, that means something for me. Um, so I like to look at this as well. It kind of gives me an idea of kind of what's working and what's not. And you can kind of see too that every month has really just been up and down. You know, we got a bunch of negatives there, and then the month before that some positives, right? And then right back down again for the most part. See? And then up again, down again, up again. All right. Um, the other thing that I like to look at is the difference year on year, right? So this was November of 2016. Okay, horrible month. You know, a lot of people talk about the seasons when it comes to trading and stuff, and I can tell you from experience that December is usually either going to be very bad or very good, because number one, people are going to be selling positions to make sure that they have tax losses for the year. Then there's also a lot of investment firms that reallocate resources at the end of the year. So they're buying and selling things in December. And then the other thing about December is that people leave to go on vacation, so there's not a lot of trading that takes place. So again, what that means is if the trend is a downward trend, it probably stays down just because there's not a lot of trading to push it back up. And if the trend is up, there's not a lot of trading to push it back down, so it tends to remain up. So we'll look and see what happens there. As you see here, last year, this is actually the month of November. Okay, it's actually the month of November. We didn't put this in until December 2nd. All right, so this is the performance as of December 2nd from November 2nd, and you see it did really well. And then this is actually December, and you see it did really well. And you see here in November, it's kind of, you know, the fact that betas did well, I'm going to say that's a down month. So I'm going to bet that the market is probably going to stay down or stay mixed like it has been over the past month. All right, that's it. Time to do some homework. I'll be back with the utility sector and the telco sector.